What do you think? How long does it take us to get to 25,000?
It's only a couple percent away right now, right? two good days we could get there. And you know, I think we probably will get there or very close, but I think after that the market is going to struggle next year. We've had an absolutely superb market this year. In fact, you know, we've had a bull market all the way, you know, since 2009. I think it's due for a pause. I think we're fully valued, 20 times earnings. I think the Fed will be raising interest rates next year. I think political winds are drifting that are going to be more worrisome for the Republicans. So I think the market deserves a breather, and I think that's what it'll get.
Okay, you point out all these good reasons. You could say that those are applicable right now. To what extent do you think this latest leg higher that we're seeing at the moment is window dressing of some sort? How do year-end adjustments typically look like, or what do they typically look like when we have a year in which the major indexes are up by around 20%?
Yeah, well, first of all, I think what we have now is really a positive reaction to the tax cut. I mean, it's a big deal. I mean, the corporate tax cut, and I think is a very, very good thing, positive. And then I think the news is out, right? No one wanted to sell before this tax cut got through because everyone said, hey, why, it's going to go up during then. Sure, there's going to be booking profits. There's going to be profit taking, although, again, the tax rates did not change a lot like they did a few years ago when the low capital gains tax expired and we had higher taxes under Obama. So I don't see a lot of reasons, certainly in this new tax law, to do a lot of shifting in terms of capital gains. I think it's really going to be a valuation question going into 2018. We had good earnings growth this year. I don't think we can keep on getting 10, 12% earnings growth into the future, certainly not, even if the economy, you know, accelerates to 3% growth, which is what the Republicans hope their policies can do.
Professor Siegel, does it matter that this rally, this latest leg up that we're seeing this week, late last week, is happening without the participation of tech, which is the best performing sector of the year?
Well, we talked about rotation. I find that very, you know, I think that's very interesting. And I think that sometimes does show a top, that we have this rotation. I do think value has suffered too long. I think it's going to be positive into 2018, too. I'm not saying that value got crazy. I mean, that tech got crazy at all. But certainly, it's been such a strong outperformer. It doesn't surprise me we're going to see the rotation, and I think that could continue into next year.
But even if this is a top, Jeremy, just to be clear, you're saying it would be a short-term correction and people would par back in and it could see us going higher?
Well, you know, there's always, you know, the short term of the market is so hard to predict. We're going to have, what, 15, 20% gain this year, maybe more in many, many sectors. I mean, that's just not a long-term sustainable type of gain for the market. Really, I look ahead and I say 7% a year is going to be the long-term normal equity gain. Now, that means sometimes it's going to be 17 or more, and sometimes it's going to be negative. But I think 7% return for equity, certainly still much better than bonds, looks to me more like a normal return, and I think that that is the type of return I'm looking forward to in 2018.